Interest rates are going up as U.S. leaders are making efforts to bring down record high inflation. And this comes after the Federal Reserve raised rates by half a percentage point, its largest rate increase since 2000. And the goal is to cool the economy and slow down spending. And this means borrowing for car loans, credit cards, mortgages will all be more expensive. Here to help break down what this means for you and your money, Winthrop University Professor Emeritus Lou Pantuosco is joining us this morning. Dr. Lou, good to have you here with us.
Nice to be here.
What do you make of the Fed's decision yesterday, and how quickly will we start to feel the impacts of that rate hike?
It was expected. That's what the economists expect. That's what Wall Street expected, and I think that's what everybody wanted too, because everybody really wants clarity now and consistency and transparency, and that was what he provided yesterday. As far as what it's going to mean, there's already been, the rate hikes have already been built in. So the mortgage rates, as you've noticed, have already gone up by a couple percentage points. The 2-year Treasury bond has already gone from 0.2 to almost 3%, and that's what's happening even prior to the half-point rate. Rate hike. So it's go ahead.
Not to cut you off, but in terms of, we hear the R word kind of thrown out, recession. Will we get to that point? And if so, how painful will it be for people? Because they're already dealing with all-time high inflation.
That was kind of the main emphasis of the press conference after with Jerome Powell. And I think he did a good job of kind of addressing why we are not at the same point that we were in the 1980s. And people keep looking at him and comparing him to Paul Volcker. And when Volcker was slowing down the economy, and what he did is he raised rates, and he was really kind of, they would say, brave about it. He raised rates and it caused a recession. It caused like a double dip recession. But unemployment at that time was 7%. Unemployment now is 3.5%, 3.6. And there are other conditions that the Fed cannot control, like the supply side issues and the oil prices mainly. That's just things. Those are just things that right at this point, are different than they were in the 1980s. So I think there's so that's where he kept talking about a soft landing, saying, I think because the labor market is so strong, because we have 11.5 million job openings and only 6 million people that are unemployed, that we're in good shape for them to raise rates a little bit. And that's what they did yesterday.
But when will people feel the effects of inflation kind of cool down a little bit? Because it seems almost everything at the grocery store you're paying more for. Gas is more, you name it, the list goes on.
I know, even dog treats.
I've started making dog treats at home, Dr. Lou. I'm telling you, because it is, everything's going up.
No, I know it's already, the question is when it's going to slow down, and it's going to stabilize. There's no doubt that it's going to stabilize. It's, the things that have been happening with food and the diesel prices and causing the fertilizer cost to go up and all that, that's going to stabilize. It's just right now though, we are spending a lot, but and GDP slipped a little bit last quarter. Mainly not because of consumer spending. Consumers spend more money because they have to. It's just what we're getting for our money that's kind of gone downhill. And of course, exports dropped a little bit, and some inventories dropped. But overall, consumer spending is going on. We keep spending, and as long as we keep getting at least some raises, which people have been doing, I'm sure you've seen the employment reports where the job quits are at an all-time high, but the rehires, when people are being rehired, they're being rehired at 7% higher, which is kind of covering inflation. So I think for right now, you're going to see this, for a few more months, but I think we're going to stabilize soon.
And with more rate hikes projected for the year, what does that mean for people who are carrying, a credit card balance or trying to get a car loan, maybe thinking about buying a home? What does that do to their dollar?
It does. Well, it does two things. First of all, you have to think about, okay, what would happen if they stop spending the money? right, then of course that's what the Fed kind of wants. And so the demand side of the whatever market we're looking at, that drops, which is a good thing. So that might lower some prices. So we might get lower prices on cars, houses, big ticket items, and then as interest rates go up, maybe they offset each other. I mean, that's kind of the hope. But it's certainly going to slow things down. People are going to think a little bit more about the big purchase items, and it is already starting to happen. But that's not necessarily a bad thing. It's good. I mean, it's something to what the Federal Reserve Bank wants to happen, so that inflation will start getting a little bit more under control.
Well, that's certainly something that a lot of people are kind of holding on to hope that happens, because budgets are being busted left and right when it comes to coughing up more cash for things.
Yeah, and it's not there. There's things that are going to change quickly. But the main thing I think is happening is a lot of this, what the Fed wants to happen, is happening without them doing it. For instance, wealth has gone way down with the stock market dropping, and that impacts the consumer spending along with interest rates. So the economy is going to adjust, and the question is it going to be a soft landing or a hard landing? And Jerome Powell is, of course, doing everything he can, and the Fed's doing everything they can to make sure that it's a soft landing.
And we certainly hope it is too, and investors will be reacting to all of this here in about an hour and 20 minutes when the markets open. So, Dr. Liu, thank you so much for being here with us and just your insight on the economy and our money. We appreciate it. We'll see you again.
Thank you.